Hey, this is Yossi. I run a small investment firm that specializes in REIT investing, and today, unfortunately, I have some bad news to share. The trade war is back and tensions are escalating once again. This started about 10 days ago when President Trump announced that he would impose 50% tariffs on the European Union starting in June. Then a few days later, he backtracked a bit and decided to delay these tariffs by a month. At the same time, he also threatened Apple with 25% tariffs on all the foreign-produced iPhones that it sells in the United States. Then he also noted that the talks with China are not going that well and that perhaps we will see a comeback to higher tariff levels. Finally, he also noted that he plans to double the tariff rates up to 50% on the steel industry. I think that this is very bad news for the entire stock market, the global economy, but especially REITs and other interest rate sensitive investments. The reason why is simply because higher tariffs have the potential to lead to higher inflation. Then higher inflation leads to higher interest rates. And over the past few years, we've seen that REITs have been very highly correlated, inversely correlated to interest rates. And so when interest rates rise, REITs will typically drop. And when interest rates drop, REITs will rise. And so if we now get a surge in interest rates as a result of higher inflation induced by tariffs, this is very bad news for the REIT sector. So there's no need to sugarcoat this. I think that it's bad for REITs that President Trump appears to be more stubborn about tariffs than perhaps we would have hoped for. But there is a silver lining in all of this. We think that this is likely to cause more volatility and uncertainty in the near term. However, the long-term thesis for investing in REITs at today's discounted valuations is still intact, and in fact, it might be even getting stronger indirectly because of these tariffs, and I'm about to explain to you why. The first reason is that while we think that these tariffs are negative in the near term, we think that the impact on inflation will be modest and only transitory. We have done an entire analysis on this topic and you can access it for free at High Yield Landlord, which is my REIT newsletter. It will be the first link in the description of this video. But in short, we think that as long as the tariff rates remain roughly at the current level and they don't make a comeback to the 100 or 200%, we think that the impact on inflation should be just modest and just transitory. This is important. And then the second reason that's perhaps even more important, we think, and we are quite confident in this, that this trade war is going to weaken the economy. This may sound like further bad news, but in the case of REITs, we think that this is actually good news because a weakening economy is going to be very deflationary and eventually bring back lower interest rates. And the reason why I'm so confident that this is going to weaken the economy is because it just causes too much uncertainty. If you're a company like Apple, you cannot make the decision of now suddenly starting to build major new manufacturing plants in the United States simply because Trump imposed 25% tariffs on iPhones, since, as we've seen now over the past few months, rules keep changing from one week to another. And so why would you take the risk of building this massive plant in the US, making this massive investment, if you think that perhaps rules will change once again in just a week from now, or perhaps when a court decides that these tariffs are illegal anyways, or at the latest when Trump leaves office in 3 years from now? Just too much uncertainty. And on top of that, I mean, even with these 25% tariffs, it's still cheaper to produce these iPhones in a country like India than in the United States. So again, I think it's unlikely that this is going to lead to the massive boom in domestic manufacturing that Trump hopes for. There are also some significant inconsistencies in these policies when you think of it, because now it's essentially putting an American company like Apple at a big disadvantage compared to some foreign competitors like Samsung, which is only impacted by 10% tariffs on the phones that produce in South Korea and sells in the United States. I think that this type of inconsistencies are only going to further disincentivize companies like Apple from moving their manufacturing plants to the United States. And so I think that ultimately this uncertainty is going to lead to lower economic activity as companies decide to delay major new investments, they freeze new hiring, and as this starts to be reflected in the economy, then consumers will get scared for their jobs, they will cut down on spending. Then this is going to further incentivize companies and also consumers to wait before making major investments, as they will predict prices to fall for things like homes, raw materials, and so on. And then we end up in this self-reinforcing cycle that may land us in a recession. We already had one negative quarter of GDP growth. JP Morgan is now telling us that we may face a recession in 2025. It's essentially a coin flip now, according to them, with a near 50% chance. And the debt market also seems to agree. If you look at the latest data from FedWatch tool, you'll find that They're expecting 100 basis point rate cuts by the summer of 2026 at the moment. And the reason why they expect these rate cuts is because the economy is weakening. This is going to be deflationary. And if that's the case, then eventually we will likely get those rate cuts to stimulate the economy. I would also remind you that by then, the term from Jerome Powell, the current chair of the Fed, will have ended. And it seems quite likely that Trump will put a loyalist in place of the Fed that will perhaps be more willing to cut the interest rates, just as Trump has been demanding for quite a long time now already. And this ultimately will be a very bullish scenario for REITs. Once again, I think that the near-term outlook is now more uncertain. It will be more volatile, perhaps even less bullish. But I think that if you can look 1 year out, even 2 years out, the likelihood of interest rates actually being cut significantly has actually increased as a result of these tariffs, because I think that it's going to significantly weaken the economy, which is deflationary and likely to lead to lower interest rates. And this doesn't even take into account another topic that we're just now starting to cover on this YouTube channel, which is the AI revolution, which has the potential to significantly reduce the cost of most goods and services. And this is just now starting to have a major impact on our economy. This is very deflationary in nature, again, likely to lead to much lower interest rates. So what are the best REITs to buy for this environment? And I think that you will want to buy REITs that are recession resistant. So perhaps avoid REITs like office REITs, mall REITs, hotel REITs. But there are most REIT property sectors are very resilient to recessions. Just think of medical office buildings, life science properties, data centers, affordable housing, cell towers, industrial parks with long-term leases, net lease properties with service-oriented tenants, again with long-term leases, grocery anchored strip centers. These are property sectors that are not heavily impacted by recessions. In many cases, not impacted at all because they enjoy long-term leases and highly resilient demand. So we want to focus on those more resilient property sectors, but at the same time, you will want to focus on REITs that are most sensitive to interest rates and therefore are very heavily discounted today, as interest rates have spiked up a bit and they have dropped in now the recent weeks. There are a lot of those examples. These might be REITs that have a bit more leverage on their balance sheet or have longer lease terms. So you will want to focus on this type of REITs, again, that have resilient properties, but perhaps a bit more leverage, which will make them more heavily discounted due to the current fears, but could enjoy much more upside potential in the coming years as interest rates eventually return to lower levels. And so what would be examples of that? There are a lot of them in the REIT sector, but what comes to my mind right now would be Clipper Realty as an example. This is a New York City focused apartment REIT that owns affordable communities in Brooklyn and Manhattan. They have a lot of leverage. So resilient property sector that's enjoying high occupancy rates and growing rents, but a lot of leverage. So it stands to benefit a lot from rate cuts, especially since today trades at just around half of its net asset value. Another example that could be quite compelling is Safehold, ticker symbol SAFE. This is the only ground lease REITs. Ground leases are extremely resilient investments, very long lease terms of up to 99 years. If your tenant defaults on the ground lease, you get the property on top of your land for free. So lease defaults are extremely rare. Ground lease has never even experienced one so far. But on the flip side, they have quite a bit of debt. They are very sensitive to interest rates because of the long duration of their cash flow. So again, they could benefit a lot. But there are many more such examples. Healthcare Realty is another one. So the leading medical office REIT. It's today offering a high dividend yield of 7 or 8%, closer to 8%, I believe. It's heavily discounted because of its debt. But its property sector, the medical office buildings, are completely immune to recessions. Whether the economy is doing bad or good is unlikely to affect your decision to go visit the doctor when you're sick. So this is a type of REITs on which I'm focusing at the moment, what I plan to accumulate over the coming weeks, because they are the ones that are the most heavily discounted. Again, because of the short-term fears of higher tariffs leading to higher inflation and higher interest rates. It's impacting them since perhaps they have a bit more leverage or the duration of their cash flow is longer. However, again, I think that over the long term, this is unlikely to change the long-term thesis, which has always been that eventually we will get lower interest rates as the world normalizes from the shocks that it went through in recent years. Remember, we had a spike in inflation as a result of the pandemic. This led the Fed to hike interest rates significantly, but then inflation has since then already normalized. Interest rates started to come down already in late 2023. The Fed cut interest rates several times. This led REITs already to recover by about 30% on average. Some of our top picks like Essential Properties, Realty Trust surged by closer to 60-70%. But then we had some additional setbacks with Russia's invasion of Ukraine, then new fears of inflation making a comeback due to the tariff policies of President Trump. These are setbacks. I think the trade war is yet another setback, but ultimately I think it's not going to change the long-term trajectory towards lower inflation and lower interest rates. And this might have been delayed now by a few quarters or even a year, but eventually as we get these lower interest rates, many of these REITs have much more upside to offer. And for this reason, my plan is to keep accumulating more shares of these REITs week after week, taking advantage of the volatility to dollar cost average into some of my top picks in this sector. As I said earlier, you can read our full report on how we think that the tariffs are going to impact inflation, interest rates, and the REIT sector for free at High Yield Landlord. It will be the first link in the description of this video. Make sure to also sign up to the free tier of our REIT newsletter. We post free content every week on some of our favorite opportunities. And if you're ready to take your REIT investing to the next level, you can also join us to our paid tier for a 2-week free trial. This will give you immediate access to my entire REIT portfolio and all our transactions in real time. Thank you very much for your support. Please consider clicking the like button, subscribe to the channel if you thought this was valuable. Thank you. See you on my next one. Bye bye.